Hey guys, Josh here with another video. Today I wanted to talk about my top 5 2022 monthly dividend paying ETFs. Monthly dividends can definitely be a huge asset for anyone looking to invest for income, specifically retirees or people seeking a large snowball compounding effect and always having that stable cash flow each and every month, not quarterly, not yearly. At surface level, monthly dividends seems like a great idea, but many investors fall way too head over heels over these monthly distributions that they don't do thorough research, investigation into what they're actually investing in. There are plenty of monthly dividend ETFs that I absolutely would not touch with an 8-foot stick, as they have done nothing but go down in value over the 10 years, but people get very sidetracked with the high yield. So we're going to break through a bunch of that crap today, avoid all the garbage ones. If you want these all in a list, I'll have a link down below to an M1 Finance pie. We'll be missing a few because M1 Finance doesn't have every single ETF, especially the smaller ones, but it does have most of them here. And M1 Finance is also offering you $50 to sign up on their platform and deposit. I think it's $100. So you get a massive return right there just by doing that. We both get $50 for that. So that would be awesome if you guys want to sign up for M1 Finance. That link's down below as well. So I want to start with the Global X Fund because the Global X Fund has several. I think it's like 7 or 8 that they have that are monthly distribution. And we're going to be going over some sister ones here today. A lot of them actually. 5 of the 6 of them are Global X funds. And they're all just a little bit different, but I want to go over the main one, the most popular one. This is one that a lot of people love. And I will say that I have a small allocation into this one. That is QYLD. So what is QYLD? QYLD is a NASDAQ 100 covered call ETF, meaning they own shares in the NASDAQ 100. Their holdings include 12% of Apple, 10% Microsoft, 6% Amazon, and so on and so forth. It's basically exactly how the NASDAQ is covered. They own these shares of NASDAQ stocks. It's a lot of high growth tech stocks, which a lot of people love anyways, and they write covered calls against them. So by doing this, they're able to keep the shares, hopefully not get assigned to the call and have to sell their shares and buy back at a higher price. That's the main thing with this, but they're able to get a great return and monthly huge dividends. Their current dividend yield is 14%, future dividend yield is 12%, so the dividends are huge. Now, the one thing we always look at, so a 12% return, obviously great. If you put 100 grand in there, you'd get $12,000 a year. That's absolutely incredible. You're not going to be seeing that in any S&P 500 dividend stocks. The only way to do this is with a strategy like covered calls. But a big thing that a lot of people worry about with all of these funds that are covered calls is writing a covered call, getting assigned on the covered call and being forced to sell your shares, which is what a covered call is, and then having to buy back higher. So this bars really, really well in down times in the market, and it just kind of does okay, stays flat line whenever we're in huge bull markets. If you are curious on how this thing is barred over time, we don't have a lot of information on this exact fund. We'll have more on the other funds that I show you in a minute. But it stays relatively flat. If you look at its inception in 2017, 2016, we're about at the same level. Your returns on these do not come through stock appreciation. All you want is the stock to stay the same. You want the valuation to stay the same because you're getting a sweet, sweet 12% return every single year without the stock going up in value. It's just a different way of looking at investing. So instead of just holding an Apple stock and it going to $200, $300 and you getting no dividends, you are acquiring new shares as these dividends pay out and you turn your drip on dividend reinvestment and you're betting on this stock to stay the same. So this is a great one. This is the number one. And now I want to go into another one that follows. It's like the exact sister of it. It's a NASDAQ 100 covered call strategy, but it's slightly different. So our number 2 stock is QYLG. So staying with Global X, it's the same exact thing, except it's a covered call and growth ETF. So what they are doing is writing calls on only 50% of their portfolio. They don't do the whole thing. So you're still getting the upside in case the market just goes zoom to the moon, but you're also protecting your downside. The holdings are basically identical. If you look at them, they have a very similar holding and net assets. Only difference is your yield is cut nearly in half to a 6%. It's still a monthly payer, but your yield is cut in half, 6%. This is, of course, a newer fund. It was founded out in November of 2020. September, November of 2020. This is when I initially figured out about this. I bought this and we are basically right back to where that cost is. But you could see that it actually goes up with the market. Compared to the QYLD that we just showed you, that has remained flat or if not down a little bit. This has stayed relatively the same. So if you are scared of the covered call strategy in a huge bull market, this is the one for you. You're still getting a decent return at a 6% yield. It's better than pretty much any stock unless if you're looking at like AT&T. which even that is getting cut. So it's going to be hard to find something this diversified and still getting a 6%. But this is the sister one. This is one that I have more money in than QYLD for sure. But those are the NASDAQ 100 for Global X. Now I'm going to show you guys one that is not a Global X fund. This is another favorite of mine, and that is SPHD. It's Invesco's fund, S&P 500 high dividend, low volatility ETF. So a lot of their portfolio is in banks, just anything S&P 500, but it's banks, it's AT&Ts, it's all those guys that are paying very nice dividends for being an S&P company. So you're getting the security of being an S&P company, and you're also getting a nice monthly dividend with a decent yield of around 4%. It really hovers 3.5% to 4%. I've seen it up to 4.5%. The stock price fluctuates. But the thing that's nice about SPHD is you really have very little downside. Your downside is if the market crashes and the S&P 500 crashes, because you own the shares. There's no covered calls. There's none of that risk that you get with the Global X funds. You instead just get their dividend payouts, and they divide it all by 12, and they give you it in monthly distributions instead of quarterly or even annually. But since 2013, you can see that this has barred pretty well. You actually get some stock appreciation as well, as it has nearly doubled in those 9 years, 8 years, whatever, probably more like 8 years. So you're still getting a 10+% return on the share itself in these bull markets, and you're also getting that 4% on top of that. So this is definitely a good one to put in any of your retirement accounts. Put on that dividend reinvestment and bet on the S&P. If that's your main bet, then this is a good one to do that. And now on to another Global X. The rest are Global X. RYLD, this is the Russell 2000 covered call. So this one's a little different because it holds 2000, the Russell 2000, which is small cap stocks. They really don't actually own any shares though. They own Vanguard Russell 2000 ETF. So they let Vanguard handle the stock picking, and they just write covered calls on that. And they have gotten great returns over the past year with 14% trailing yield. So 14% dividend over the last 12 months. Currently right now they're at 12%. But this is another new one. They have a pretty decent chart that looks like they're going to be one of those stable ones. They are purely a covered call ETF, so they have no safety net around the market rallying, but these are Russell 2000. So it's a really low cap stock, so they're not super high growth anyways. So I really like this one. This is a good bet against the whole economy, or bet on the whole economy as a whole, because you're betting on every little company. The Russell 2000 is mixed of crazy amount of companies at all different sectors. So this is a good investment for anyone that really is confident in the US economy, the world economy as a whole. Now I have the final two stocks, and these are both the same as the first two, except they are not the NASDAQ. They are the S&P, and that is XYLD. This is one of the oldest ones that they've been doing, so we have the most data on it, and this is a covered call ETF, but they've been going for 8 years, and they have a great return as well, sitting around the 10 to 11% distribution yield. But since it's been going on for so long, we have a lot of charting and a lot of data from the past nearly 10 years. So looking all the way back at 2013, it's entered at around $40 and we're at 47. So we could see long term over many different markets, including COVID and everything, we have remained in a uptrend pattern with the S&P 500. So that is a good sign. We're getting 10% yields while also getting slightly positive appreciation on the stock itself, which is mainly what we're looking for. Then, of course, the sister one to that is the covered call and growth ETF for the S&P. Just like QYLG, this one also has a similar yield, around 6% right now. They had 8% on the last year, which it was just incredible for them because they're following the S&P 500 as well. So they're in a great position. We could look at this one's chart as well, and you'll see that we don't have a lot of data on them, but they have rode the bull wave all the way up and, of course, have found it all the way down. But this is exactly how they intended for QYLG and XYLG, which is why they are some of my favorite, regardless of having lower yield. I'm not looking for income. I'm not near retirement age, nor do I not need the income from my stocks. So the fact that I could collect some of this appreciation, just natural share appreciation up, and not have such a hard downfall as the S&P itself, I'm able to collect a 6% dividend while also collecting appreciation. That's why XYLG has become one of my top buys for 22, especially in our recent most dip, where I've been buying quite a lot of XYLG and pretty much all of these monthly payers in my dividend portfolio. But hopefully you guys got to see some of the new shares and I explained them enough for you guys. These are all ETFs. and safe monthly ETFs. Monthly ETFs can be very risky, so you got to watch out whenever you're looking for these. These are the only 6 that I would touch. And if you guys have any more that you would want me to look into, let me know. And feel free to look into that M1 Finance promo down below. If you guys did enjoy the video, please do subscribe and leave a like on the video. Have a great day. Bye-bye.